I've been in Wall Street Digest, Active Trader, and of course my stuff is on Benzinga as part of the Marketfy effort now. I've also worked on some books over the years with people like David Darst and Chris Brown that were eventually published as part of the Little Book series by Wiley, and that was a real learning experience for me. I really improved my investing skills working with those guys. Skip the slide. All right, today I just want to go over a couple of things. First off, when it comes to longer term investing as opposed to trading, most investors really are their own worst enemy. They do a lot of things that just make it almost impossible for them to even match the market, never beat the market, never mind beat the market. So I kind of want to go over those and some of the things that you can avoid doing that will increase your chances of earning a decent long-term return in the stock market. And of course, we want to address why value investing. You hear some of these guys talking over the next day. There's a lot of exciting things to do in the stock market. There's new systems and approaches, and owning the really exciting growth stocks seems to be the way that most people want to approach the market. So why should we adopt a value investing style? Then I want to kind of take you through the process, how we pick stocks, how we find stocks that are safe, cheap, and have the potential to go a lot higher over time. It's a rigorous process. I want to kind of walk you through it and make sure you understand how it works. And then, of course, we want to show you just some stock picks over the last couple years that they were published in real time as we made them and as we bought them, and how they've done. So let's just kind of jump right in. And if I see any questions, I'll try to jump in and answer them as quick as I can. So feel free to type your questions in. This is from a study that was done in 2011 by a couple of professors at University of California, Davis. And they looked at the performance of individual investors over a very long period of time. They looked at it over a 20-year period of time. What they found is most investors, not only don't they beat the market, they underperform it very, very badly. They have a couple of habits that almost make it impossible for them to earn a decent rate of return. Most investors will sell a winning investment almost immediately. This is something that I ran into constantly as a broker, where you'd buy a stock for somebody or a mutual fund or any other investment. It goes up 10 to 15%. They want to sell right away, even though the particular investment is just starting to work. And every trader has seen this at some point in their life, where you enter into a security for a trade, it goes down, and it becomes a fine long-term investment opportunity. People have a hard time getting out of stocks, funds, or other investments that just simply are not working. There comes a time where you have to cut your loss and run. The other problem that individual investors have is, if you're working, whether it's as a trader, a doctor, a lawyer, no matter what your major focus of the day is, you're married, you have kids, you have hobbies, you have interests, there's just not enough time in the day to put the research in to evaluate the investment choices that you might have for your longer-term investment portfolio. So investors tend to get heavily influenced by sales pitches, advertising, what's popular, the hot stock or the hot idea of the day. And in the study, they found that most investors tend to hold very undiversified stock portfolios. It's really hurt individual investor performance over long periods of time. And I was actually shocked to find out how badly the individual investor actually does. BlackRock, the asset management firm, got together with Dalbar, an equity research firm, and they looked at 1992 to 2011 to see just exactly how individual investors have done, and they compared it to some other asset classes. They gathered the data from various mutual fund and brokerage organizations and tabulated exactly what the individual investor's rate of return was. Now take a look at this. Oil went up 8.6% on average over this 20-year period of time. But look at stocks. There's 7.8% annualized return over the 20 years, in spite of two horrendous crashes, the 2000 to 2003 period, and of course the one we all just got to enjoy in 2008 and 2009. The market still has earned about 7.8% per year over that period of time. Go all the way to the far right, individual investors have earned 2.1% on average over the last 20 years. That's horrible. When you dig into this a little bit deeper, you find that not only didn't they beat the market, they didn't even beat the inflation rate. They're actually behind the 8 ball from where they started 20 years ago. We found that individual investors trade entirely too much in their long-term stock portfolios. They move from hot investment to hot investment, hot fund to hot fund, in search of what's exciting, what's working now, what has worked over the last year. From a long-term perspective, that's exactly the wrong thing to do. Momentum works great for traders. It's horrible for longer-term investors. So what do we do about this? How do we improve our long-term investment performance over time? Now, this answer is not going to shock you, given the title of my presentation. I think investors should turn towards what Benjamin Graham developed 90 years ago as value investing. Now, value investing gets, everybody talks about it. They're a value investor. They bought the dip the other day when it was down 2%, so they're a value investor. They bought a stock with a PE of 15 when the market PE is 20, so that's value investing. It's not. Value investing, the way we practice it, I call it asset-based deep value investing. We're looking to buy stocks that trade for significantly less than their asset value and hope over time to capture that discount. Now, it's been around for 90 years. Ben Graham developed these concepts back in the 1920s and 1930s. Since that time, it's delivered consistently above average returns. You can take just about any 5, 10, 20-year period over the last 90 years and break the market down by stocks, by deciles of price to book value. The stocks with the lower price to book value always have consistently, over time, outperformed the broader market and the more exciting stocks. In the short run, you might have a year or two where the exciting stocks in the market outperform the deep value stocks, but not over a 5 or 10-year period. It simply works. It works extraordinarily well. And one of the reasons, very few people actually practice the method. I'm not aware of any large hedge funds that are practicing deep value investing, simply because the opportunity set really keeps them out of it. If you're running $5 billion, you can't own the type of small, safe, and cheap stocks that you and I can as individual investors and capture that discount between the current stock price and the actual asset value of the underlying company. Most people aren't patient enough. We talked about the fact that individual investors tend to overtrade. They chase performance all the time. They move from stock to stock every 3 months, every 6 months, some people every week in their long-term accounts, which to me is absolutely crazy. I've held stocks as long as a decade, and most successful and value investors have. Now, I've had a few that have worked out quicker than that, but we basically hold stocks until they work, until they become fully overvalued. And literally, we've owned stocks for 5, 7, 10 years over my career. It's pretty consistent. Most people lack the patience to do this. Also takes an awful lot of discipline, because you're buying stuff nobody else wants, nobody else has heard of, and you're usually buying at a time when the market's been selling off and everybody else is panicking and dumping out of the market. Now, as I said, I've been doing this for 30 years now, and I learned from some of the absolute best in the business. So I've learned to develop the patience and the discipline to make these market fluctuations work for me over time, and buy the cheapest and the safest stocks currently available in the marketplace and hold them until I get the rate of return, until I capture that discount between the current stock price and the actual asset value of the underlying corporation. Okay, let's talk a little bit more about how value investing is done over the years. It's been studied and studied to death, with the first and most famous study being done by professors at the University of Chicago, Fama and French. What's interesting is these guys set out to prove that the market was efficient and that there was not a method to actually beat the stock market over a period of time. What they found was exactly the opposite. They found that stocks trading below book value beat the market averages, and small stocks trading for less than their book value outperformed the market by a significant margin. It's about a 3-to-1 margin over the 1963 to 1990 time period. So the market's turning in about a 7% annual rate of return over that time. Small company stocks trading below book value outperformed by a 3-to-1 margin. Now, the professors decided that these stocks, if they gave that much higher return, they had to be that much riskier, and that was the conclusion they reached in the study. But as we go through that, I think you'll find that that's not exactly the case. There is a liquidity discount factor in this. Large institutions simply cannot play around in the smaller price to book value stocks. You don't run into high frequency trading or ETF effect down in the smaller stocks, and that works to our advantage as individual investors. What was really interesting to me when they did this study is if you look at this chart, the bottom 4 deciles, that's just simply the market divided into 10% groups, all just handily beat the stock market. And there's going to be all the stocks basically that trade below price to book value. I certainly hope there's a table up on the screen. I see the question saying that there's no chart up there. I hope everybody can see it. But if you look up here in the far right-hand corner, you'll see that the very lowest price to book value stocks in the smallest market capitalizations over a really extended period of time, 27 years, beat the market by almost a 3-to-1 margin, but they're compounding at 23% a year over that period of time. I don't know of any other investment strategy, mutual fund, hedge fund, or just about anybody out there that's compounding at 23% a year over almost a 30-year period of time. That's extraordinary. Even if you go down here to the very largest cap stocks, you can see that if you were patient, waited for the market to sell off, and bought the big stocks when they were trading at a significant discount to tangible book value, you earned still a substantial premium over what the market provided. You earned about 14.2% a year versus 11. A 3% advantage over the market over 30 years is going to add a significant amount of money to your account. You take it all up, you add all of them together on all capitalization style, you've got almost a 20% return versus just about an almost 8% return for the market. So that was the very first study that looked at, does value investing work? Does buying stocks at a low price to book value actually add value for an individual investor? And the professors found that, yeah, it very much did. This chart was given to us by a money manager by the name of Donald Smith and Company. We sort of lifted it off of his website. He just did a study from 1951 to 2009. Again, an extraordinarily long period of time, and he found the same thing using the CompuStat database, that buying the very cheapest stocks based on price to book value gives you a huge advantage over the stock market. If you look at about the 6th and 7th decile chart there, that's going to be pretty much the area that the broader market is in. You'll notice that towards the right it does start to swing up as the glamour stocks and the growth stocks that trade at a higher price to book value also tend to outperform the market a little bit, but they do not catch up with the value stocks over time. And this is just simply another chart that kind of makes the point for us, and they've broken this one out into price to book value. It's 1927 to 2010, so pretty much a 90-year period of time. And you can see that the lower price to book values in all these time periods, 1927 to 1960, 1991 to 2010, pick your time frame as a long-term investor, and you were much better off owning the cheapest stocks, the ones that nobody had heard of, nobody had cared about, that traded for less than their tangible book value, were the way to go for an individual investor. You earned a higher rate of return than the guys in index funds, than the folks trading, the more exciting stocks of the day. So buying the cheaper stocks absolutely works over time. And this is just another chart from the Brandeis Institute that kind of helps us make the point a little bit that the lower price to book value stocks, again, over time, this is 1968 to 2010, there's consistent, everybody that's gone into study what works and does not work in the stock market, has come back and said buying stocks for less than the underlying asset value works. Most people don't do it because as I said, it takes a lot of patience and a lot of discipline to make this work for you. Most people just don't have it. There's something in the average human's psychological makeup that makes it very difficult for him to buy a stock that's wildly out of favor, that nobody else is talking about, and then hold it for 5 years until it trades at a premium to its asset value. Sounds simple. In practice, as it turns out, it's actually not for most of us. All right. All those studies were done a long time ago, some in 1990, in the 2000s. But there's been a couple of recent studies that also make the point. Wesley Gray and Tobias Carlisle recently wrote a book called Quantitative Value, and I highly recommend that you read it if you have an interest. And by the way, yes, I see the question. Yes, price to book value ratio could indeed indicate significant problems with the company, and we are going to cover that in a minute. Just because a stock is cheap does not mean that you should necessarily buy it. I'd say 80 to 90% of the stocks that are cheap for a very good reason. Yeah, you want to try to figure out and avoid the ones that are on the way to bankruptcy. And we're going to get to that part because there is a way to do it. But in quantitative value, these guys wrote a fabulous book. They looked at stocks from 1964 right up through the end of last year, 2012. They found that the stocks trading at the lowest price to book value compounded at 13.11% versus about 9.2% for the S&P from 1964 to 2012, about a 48-year period. 9.2% over that period of time. So that's not terrible, guys. If you put $1 into the S&P 500 at that rate of return, it grows to about $81.92 by the end of the time period. That's not terrible. However, if you put it in the lowest price to book value stocks, it grows to $520, or a little more than 6 times just the market rate of return. And again, that's a fabulous book. If you have an interest in long-term value investing, I highly recommend that you buy it. And I threw this last one up here because just found this book a few weeks ago. It's called Net Current Asset Value Investing by a guy named Victor Wendell. And what Mr. Wendell does is he looked at stocks going back over a significant period of time, but I'm going to deal with the 2000 to 2009 period of time. He bought stocks trading at 70% of their net current asset value, which is a term you'll hear me use a lot. Net current asset is just simply current assets that can be liquidated to cash over the next 6 months on the balance sheet, minus all liabilities of the company. No values given to plant, property, equipment, anything else. Inventory, receivables, cash, short-term investments, the only thing that we value here. Stocks trading at 75% of net current asset value. Now, as you can imagine, these are going to be very unpopular, very small, completely unknown companies. It's a technique I've used all of my career. There's not always a ton of them around, but when you do find them, you almost have to buy them. 2000 to 2009 was a horrible period of time to be a long-term investor. In fact, you lost money. You ended up with about a 3% a year loss on average just holding an index fund over that period of time. Had you confined your investment activities to just buying those stocks that traded below their net current asset value, you would have earned 27.04% over that 10-year period of time. That's a market-crushing return. That's an incredibly wealth-building rate of return just by focusing on stocks that nobody else knew and nobody else cared about. And by the way, your biggest year would have been 2003, when virtually all of the internet companies traded for less than their cash value, and a lot of them were actually still profitable at the time, but everybody was so terrified after the internet meltdown that they absolutely would not touch them. It's worth remembering that one of those stocks was Priceline. Priceline actually was so unpopular it traded for less than the cash value on the balance sheets, and we all know where that stock is today. So you can uncover some tremendous bargains and make a lot of money with this approach. It's worked historically. It's worked in practice. And I think it can work for you. Now, here's where the problem comes in. And I'm just going to use this information from the Brandis study. It's one of my favorite studies. A lot of the stocks that are going to qualify as value investing is going to be stocks that have dropped substantially over the last 12 months, obviously. Charles Brandis at the Brandis Institute did a study. What happens to stocks that drop by 60% in a 12-month period? As a group, they outperform the market. If you buy all these stocks that drop by that much in a year, they outperform the market over the next 1 and 3 year period of time. However, what we find is a lot of these stocks go bankrupt. In other words, they fell 60%, became cheap, and traded for less than price to book value for a very, very good reason. There was something fundamentally wrong with the company. The portfolio outperformance is the result of just a handful of these broken companies that actually fix themselves, right the ship, survive, and go on to thrive. So the trick for a value investor is to figure out which one of these companies, which of these companies that are trading below price to book value and that have dropped a lot in value, which ones have the ability to survive, go on and thrive, and see the stock price move up by a substantial amount over a 3, 5, or 10-year period of time. And that's where the value investing process starts to come into play. Right now, I ran a screen last night looking for stocks traded on a U.S. exchange that trade for less than their price to tangible book value. Right now, there's 2,000 stocks that trade for less than the asset value of the company. Most of those 2,000 stocks are cheap for a very good reason. They have too much leverage. They're on their way into bankruptcy. They sell a product nobody wants. I mean, I'm sure that the very last buggy whip manufacturer in the United States traded for less than book value right before the owners had to liquidate the company because the automobile had pretty much made them obsolete. Most of the companies that you're going to find in those lower 2 deciles of stocks that trade below book value trade there for a reason. You don't want to own them under any circumstances. Right now, when I add my filters over top of that list of 2,000 stocks, I come down to less than 0.5% of those 2,000 stocks would actually be a strong buy candidate for a deep value investing portfolio right now. It's taken me a long time and a lot of real-world education buying the wrong stocks to figure out what does and what does not work. In identifying companies with the ability to survive and then thrive, but I've gotten pretty good at it over the years, and we've developed a series of tools that definitely, no, that's not 10 stocks, that's about 50 stocks. Is that right, or did we make a mistake on the slide? Yes, that should actually be 5% of the stocks. I'll have to go back and hit somebody for that one. Okay, how do we narrow it? It's about 50 stocks that actually, out of the 2,000, they come all the way down to the point where they are actually strong buys. How do we do that? The very cheapest, the lowest decile right now, that bottom decile that offers the 23% of your performance in the studies. Now, actually, thank you, Marco, because I have to yell at somebody for that slide now. The cheapest 10% of stocks in the market based on book value right now is 1,000 stocks. Vernon, I'll get to that in a second. Cheapest 10% of stocks is over 1,000 stocks. Most of us don't have the wherewithal to own 1,000 stocks. So what we're going to have to do now is we have to take this pool of stocks that trade for less than book value and to begin to break them down using credit scoring and fundamental analysis. Now, Chris Brown at Tweety Brown used to tell a story of, can everybody else see the slides? Is that up there? Okay, so most folks can see it. Of actually having to go through the old S&P stock guide, and if you're an old guy like me, you remember that book used to come in the mail every Friday, had every stock in the United States in one little gray booklet. And Chris and John Spears at Tweedy Brown, their first job was to go through that book, find the stocks trading by under book value, and do the credit scoring and fundamental scoring by hand. It would take days with 2 or 3 guys doing it. Today, of course, I can do a great deal of this on the computer and have the whole 1,000 or 2,000 stocks screened down in about 2 to 3 hours a week. Now, once we have these broken down, we're going to start to figure out how and where to buy them, and more importantly, I guess, how and where to sell them at some point in time. So for every stock, I'm going to try to put together 3 prices. First, I want to figure out what the company's worth as a going concern. We're going to look at cash flow, at earnings, at growth, at the assets that the company owns. What type of assets are they? Is it cash? Is it real estate that may be going up and down in value, or some type of equipment that's depreciating? We're going to treat it much like your realtor does a house, and we're going to look at the comps. What have other companies in the industry sold for as far as a multiple of earnings, asset value, or cash flow over the last year? We'll put all this information together, and we're going to come up with what I call the intrinsic going concern value. This is what the company is worth as an ongoing business going forward. Then I want to know what's the tangible book value. What is the absolute net asset value, assets minus liabilities, just like the net worth statement that you're doing when you apply for a mortgage loan or any other type of loan. That's the number that I base most of my practice off of. I'm trying to buy stocks, numbers usually 80% or less of tangible book value. There are some exceptions around that number, but it's usually 80%. That's where I want to buy a stock once it's passed all my credit and fundamental tests. Then I always calculate the liquidation value. And here we go through, we discount receivables, we discount inventory, we figure out the fully depreciated value of other assets, we price the real estate like it would be sold in a fire sale. What's this company worth if they liquidated the thing and returned the cash back to me? The liquidation value of the company is my double down point. So if I buy it at 80% of tangible book value, it trades below liquidation value, that is where I'm going to double down and add to my position. If the stock hits the intrinsic going concern value of the business, I'm a seller. Sometimes that happens in a year, but that's pretty rare. In a perfect situation, the company executes a turnaround, business gets better, the sector improves, the economy picks up, and that going concern number goes up quarter after quarter after quarter after quarter, and the price never catches it. And that's when you get a stock, like Geico or Green Tree Finance, that I owned back in the 90s, where literally the stock goes up by 50, 60, 70 times your original purchase price over a 7, 8, 9 year period of time, because the price never catches up to what the business is actually worth. Now, sometimes it catches up in a year or two, and we end up selling it right away and moving on. A perfect stock, and you only need 3 or 4 of them in your lifetime to make a huge difference. If you get one of those ones where the intrinsic value keeps going up, you bought it at a discount to tangible book value and can hold it for 8 or 9 years, it's going to make a huge difference in your long-term rate of return. Here's one that just kind of an example of a stock that we're buying right now and exactly how the prices would work. And my publishers whited out the ticker symbol because I'm not supposed to give any stock ideas away for free. It's a small cap semiconductor company, has huge exposure to the consumer electronics business, which is not very good right now. It's very, very flat and has been for several years. Adding everything up, doing the comps on sales in the industry, the underlying growth rates and asset value of the corporation, we figure the business is worth $13 to $14 a share as an ongoing long-term business. The tangible book value is about $10.47, trading right now around $7.69, $7.70. So it's certainly cheap enough for us to be buying. It's under 80% of tangible book value. They have an enormous amount of cash on the balance sheet. They do a great job of managing the inventory and no long-term debt. If they liquidated everything at fire sale prices and just gave me back that money, it's $7. So if the stock at $7.69, I'm a buyer. If it goes below that 7 by 10%, I'm going to double my position, because at that point I have an enormous margin of safety. The company can go out of business and I'm going to make money at that price. So that's kind of the process we go through with every stock in our portfolio. We take those 2,000 cheapest stocks trading below book value, we run them through the funnel of credit analysis and fundamental analysis, and sometimes a little bit of common sense analysis, making sure we're not buying a buggy whip manufacturer. Then we derive the three prices, and that's how we manage the investment portfolio of cheap stocks over a long period of time. Yeah, Marco, of course it does. When we do liquidation value, we've netted out all of the debt at face value. This is just going to be the equity that's left after everybody else has gotten paid. Because if it does go bankrupt, you will be absolutely the last one to get paid. Which brings me to a point. I do not like a lot of debt on the books. And a company that owes more than it owns is usually not going to make it through my first series of credit tests. If there's more debt than equity, there's nothing left for me if everything goes wrong. So I'm probably never going to own that company. And yes, preferred stock gets netted out as well. When I'm buying a common stock, my margin of safety has to be determined on the price of that, price and value of that common stock. I have to subtract out everybody that's going to get paid over top of me when I'm determining the liquidation value of a company. Otherwise, my analysis is going to be completely wrong, and I won't get paid. And I've developed a fondness over the last 30 years for getting paid. Now, let's just take a look. These are just results from the last couple years, guys. Now, keep in mind that I do keep my position size fairly small in my portfolios. I want to own as many of these things as I possibly can. How large is which universe, Jim, if you would type that in, and I'll go through that again. But here's just some stocks over the last couple years. These were all made very publicly, most on realmoney.com. Some are on Daily Speculations and a few of the other websites that I've written for over the years. At the end of the year, I guess it's almost a tradition that everybody that writes about stocks is going to pick your stocks for the year ahead, and you pick your 4 or 5 best stock ideas and you write a column about it. It's really a horrible idea, and we shouldn't do it because it's not really the way to run your business, but we do it every year. So this year I picked 4 stocks. I picked Hardinge, which is just, they make machine tools. They're a relatively small company. Nobody's ever really heard of them. They do a fair amount of business in Europe and China, but they are based here in the United States. Now, machine tools are not exactly exciting stocks. Nobody really cared about it. It was trading at 80% a book. It was debt-free, had a lot of cash on the balance sheet. Business was just okay. They got a couple of big orders. The stock caught an analyst upgrade. So far this year, the stock's up 54.8%. That's not a bad rate of return. The liquidation value of that thing was probably about $7. So it was really very little risk in the position. There was no risk in Tecumseh Products when we picked that up. They make compressors for HVAC and refrigeration, very much tied to the housing business and to the economy. Business has been horrid. It's been horrid for about 5 years. But it was trading at about a third of the tangible book value of the company. It was trading for about half, I think, of what you could have actually liquidated the whole company for and returned the cash back to investors. There is A and B shares. There's some elements of family control in the stock, and it was also keeping kind of a lid on the price. But an activist investor came in, and he bought up a big chunk of the company, started really pressuring management to unlock the underlying value of those shares. That caught Wall Street's attention. It caught a couple of analyst upgrades. A few funds piled in. The stock's up 142% since I wrote that column on December 28th of last year. Bank of Ireland, a lot more risk in Bank of Ireland when I bought that stock than in some of the other ones. But it was trading at 40% of tangible book value, which is kind of my cutoff for distressed, large cap, too big to fail type of banks. The real key there was that Wilbur Ross, a private equity investor, came in and participated in the recapitalization of the bank And right there I had a margin of safety. There was no way that he was going to let the bank go under with that level of capital investment. He would continue to support the bank. Stock's up about 41% so far this year. Now, I'm not supposed to give any stock ideas away, and I'm certainly not going to do that here, but my favorite stock right now is this last one. That's Vault Scientific. It's a staffing company for the high-tech industry, and it's kind of the little brother of the stocks on that list. It's only up about 13.7%. They've had some problems with their financial statements over the last couple of years. They've had to do some restatements, but the stock is trading at about half of book value and maybe 3 to 4 times free cash flow. So it's extraordinarily cheap. Have any of my picks ever gone bankrupt while I held them? Yes, years ago. Not in recent years, since we got a lot better at credit scoring. Vernon, I don't confuse a bull market for brains. As I said, I've been doing this for 30 years. I've seen just about every type of market that you can see, including 3 of the worst bear markets of the last 50 years. And although we certainly had our account values go down, we've never suffered significant losses from a portfolio that we continue to hold as long as the value is there. Yeah, I know it has no trading value. Most of the shares are now in the hands of guys like myself that are long-term value investors. We've been buying it over the last year, and we're probably not selling anytime soon. But if you can get some shares at right around this price, over the next 2 or 3 years, you will make a lot of money. Again, in April on Real Money, I published an article on mechanical value investing. All I did is I just ran a simple screen using the value line universe of stocks. We looked for stocks that were trading below book value and had more equity than debt. And we came up with a few, and we ran them through a couple other credit parameters. We came up with 3 stocks. First is Neutral Tandem. They're an internet protocol company. Absolutely nobody cared about these guys. They were trading at about 70% of book value when I wrote the article. They declared a special dividend. They got 2 brokerage firm upgrades. The stock has almost tripled just since April. Not every stock I pick is going to do this, but I only need 1 or 2 a year to do it to make my rate of return in excess of the market. Career education, I actually hate the for-profit education industry. I think it's a terrible industry, but the stock was trading for less than the value of the cash on the books, so we bought it. It's up about 53%. Tel Labs, again, I still own this stock. I would still buy it in a new portfolio today. It trades at about 80% of book value, and it's up about 12% a year. There's absolutely nothing great going on with the company. Probably won't be for the next year or 2, but I think sometime over the next 3 to 5 years, I will be able to sell the stock for a significant premium to this price. I'm going to try to come back to some of these questions. They're kind of on the scroll down, and I can come back to them. But please continue to ask them. And here's just some more winners. We just went through and tried to pick out some of the stocks that have worked over the last year. Not all of them have done this well. We have a lot of stocks that are down, some that are sideways. But when I add these to a portfolio, to an average portfolio, I end up with market-beating performance because I have a few of these things. S&V is just a regional bank. It's trading at 70% of book value. Had horrible loan losses coming out of the credit crisis. Management got smart. They sold off all of their problem loans and started concentrating on repairing the loan book. It's working. The bank is profitable again. The stock's up about 53%. We bought Micron when everybody hated the semiconductor business. Nobody was ever apparently going to use these things again. And stock's up 51% since we bought it. And yeah, I do still own it. We're starting to trim it a little bit. But yeah, I do still own it. Applied Molecular supplies materials to and research services to the biotechnology industry. Again, at the beginning of this year, they had lost a contract. Business did not look that good. They added a couple newer contracts in. They caught a recommendation from a major Wall Street firm, and the stock has better than doubled since January. Zolt is one of my favorite stocks because I just absolutely detest the industry that they serve. They sell carbon fiber that's used in wind turbines. Now, wind power is so far away from being a viable industry that you could not get me to buy one of the stocks. These guys were making pretty good amount of money selling the carbon fibers to the guys that had gotten government and agency contracts to build these wind turbines. Then they developed some new uses and started selling into the auto industry. They had an activist investor come in and say, hey, you guys are not running the company for for the benefit of the shareholders. A little bit of change in management's attitude, and the stock again has better than doubled since last November. Banco Popular is the Puerto Rican bank that got into so much trouble in the credit crisis. Slowly but surely, things have gotten better. They've made a couple of acquisitions. Their loan losses are slowly getting better, and the stock was trading at a significant discount to book value, and it's up 70% since we bought it a little over a year ago. Republic Jets we bought in 2012. Everybody thought this thing was going to go bankrupt. They were going to try to sell one of the two airlines, I believe Frontier. There were no buyers. Nobody thought they were going to make it. However, they were trading at that time, I think, a third of book value. Slowly but surely, business got a little bit better. The airline business picked up, it picked up, it picked up. They signed a couple of new contracts. The stock has gone up 269% in just a little over a year. Again, it was a small position in the portfolios, but you don't need a lot of these to offset any laggards in your portfolio and turn in a market-beating performance for the year. You just need a few. It's been a kind of a very strong market over the last year, so it's been more than a few for the last 2 years. We've had a pretty good percentage of the portfolio that's moved up much faster than I would have expected. All right, let's talk about selling. And I see all your questions. I promise I'm going to come back to them at the end. There's pretty good questions there. When do we sell? Some people talk about selling at the end of a year, selling based on some technical. I hold it until it works or something changes at the company. We've calculated that ongoing concern value. When a stock gets to that value, I'm a seller. If it never gets to that value and nothing changes at the company, I'm probably not going to sell the stock. As I said, I've held stocks for a decade. The simple truth is that if you put these companies through the credit test, you put them through the fundamental checks, and they have a viable business, most of these over time are going to work out. Some are going to work out in a year. Some are going to take 5 years. A few will take 10 years. A few will turn around and become those great stocks that never catch up to their intrinsic value and add just a tremendous amount to your net worth over a decade. But the vast majority of them, if you've done everything right, at some point they're going to work and trade up over that intrinsic value, and you can sell them. Until that happens, I have no interest in selling. If we get a bad market, I'm still going to focus on what that company's worth. If it goes below liquidation value, I'm going to buy more. I am far more worried about what I think the company is worth than what the stock market is pricing it at today, unless there's a discrepancy I can take advantage of. This was not easy to learn to do this. And as I said, I've had some great teachers that helped me develop what I call a private equity mindset. You know, a private equity manager goes in, he buys a company, he holds it 5 to 7 years, he sells it back to the public. He's buying stuff nobody else wants and selling it when it's popular. You're seeing it right now. Private equity shops bought a lot of real estate in 2000, 2008 when this thing started to come apart. Guess what? They're starting to sell it back now that there's signs of improvement in the housing market and investors are excited about it again. We're seeing an extraordinary amount of private equity real estate related IPOs right now. We talked earlier about investors always selling things too soon. There seems to be a mindset with investors that the market's open, we have to do something. And the brokerage firms certainly encourage that. Even the discount firms that claim to be objective, you know, they'll give you every 10th trade free or 20 free trades to open an account. your broker's going to send you a research report that says, the stock's up 25% since you bought it. You really ought to sell it and move into this next stock. The market's designed to create activity. Traders, short-term traders, can take advantage of that activity. And most of the short-term traders I know, by the way, take advantage of the so-called longer-term retail investors' inability to sit still and buy and sell stocks at the wrong point in time. Just because that casino is open does not mean that as a long-term investor, I have to do anything. I can go days, weeks, and even months without buying or selling a stock. If it doesn't fit my buy criteria, I won't buy it. If it's not fully valued, I don't feel the need to absolutely rush out and sell it just because the stock market is open and it's trading for more than I paid for it. So one of the biggest parts of being successful as a long-term value investor is you do not have to trade every day. You have to stick to the discipline of buying it when it's cheap and selling it when it's fully valued. Oh, that's up here. Now, guys, I'm not a market timer by any stretch of anybody's imagination. I flirted with market timing as a very young man. I am horrible at it. If I ever gave you specific instructions to buy or sell a stock index on an exact day at an exact price, you would probably substantially increase your net worth by doing exactly the opposite of what I said. But having said that, when you focus on valuation, you get a little bit of it's not an exact process, but you got kind of a natural timing mechanism. In the aftermath of a steep sell-off, like you saw in 2003, 2008, there's literally hundreds of quality, cheap stocks around. Even a lot of your great blue chips will start to trade below tangible book value. In 2002, Apple was below tangible book value. As I said, Priceline traded for less than cash. In 2008, we were picking up a lot of small to mid-sized banks that had absolutely no credit problems when compared to Citigroup or Bank of America or the bigger banks. We were paying 60% of tangible book value for them because banks were so unpopular at that point in time. Also the case with infrastructure stocks at the time because nobody thought that anybody would ever spend money on anything again. So there's hundreds of stocks around that you can buy that trade at a significant discount to their tangible book value, and lots of stocks trading at that 75% or less in net current asset value. You can kind of pick the ones you want when the market's selling off and everybody else is panicking and big funds are getting margin calls. As the market works higher over time, you're going to be selling stocks that hit fair value, and if you could find others to replace it with, you will. However, eventually the market gets to a point where you're just simply not finding replacement candidates. So your cash balances are building up as the market goes higher. So I said it's not a precise timing mechanism. But as the market goes higher, you're selling stocks that hit full value. You have nowhere to put the money if you maintain strict discipline. Your cash balances go up as markets move into a market top. And then you're just kind of sitting on them until the market sells off and creates a new opportunity set. And again, I'm not ignoring your questions. I promise I'm going to come back to them when we whiz through the little slideshow here. All right, let's talk about where we are now in the markets. We've had a great run. Market's better than doubled off those 2009 lows. We had a strong year last year, and we're having a pretty good year so far this year. What's happened is the opportunity set has gotten very, very, very small. My whole research of stocks that go all the way through all the tests is about 50 companies at this point in time that are cheap enough, safe enough, and pass all my credit and fundamental checks to buy. Just happens every time you get an extended run in the stock market. We sold some stocks over the last year that we bought in 2008, 2009, 2010. That we bought at extremely cheap prices, but now they're fairly valued, and that's particularly true in the real estate space, where, as you can imagine, in 2008, 2009, that stuff was pretty cheap. It's pretty fairly valued at this point in time. Where we do see some very cheap stocks in the energy stocks, especially those in the unconventional fields in the United States and in Canada, the exploration and production companies in that area. We have a glut of natural gas. Pricing is absolutely horrible, as everybody knows. When that works itself out, I have absolutely no idea. But what I do know is I'm buying quality companies with assets that can reasonably be liquidated to cash on fairly easy terms that are trading at 50 and 60% of tangible book value. It may take us 5 years and 2 new presidents before somebody figures out that we need to be burning natural gas in a lot more ways to fix some of our energy problems. But I honestly believe that that's going to happen at some point in time, just because it makes a lot of economic sense. When that happens, these companies will see the revenues grow, drilling activity will pick up, margins will expand, it'll be extremely profitable, and these stocks will trade at much higher assets of earnings and much higher multiples of assets and earnings, and they'll hit fair value, and I'll sell them. It's probably going to take a few years. These are not stocks I expect to make money with over the next few weeks, months, or even over the next year. If they dig stuff out of the ground right now, it's probably pretty cheap. We're seeing extraordinary values in iron ore companies, gold miners, although I'm not really a fan of anything associated with gold. It's a very emotional market. But I do like the silver miners here. Again, trading 50% of tangible book value. Could probably liquidate these companies for less than the current stock price in a patient liquidation. In a fire sale, I think you'd still come out even on most of them. Small banks right now are extraordinarily cheap. Now, I know most of you guys are traders. You're thinking about short-term gains, new ways to make money on the day-to-day. But I'm going to tell you that if you are not buying small community and regional banks right here, right now, at these prices, you are leaving potentially millions of dollars on the table. We came out of the savings and loan crisis in 1991. Something very similar to this, but not as extreme, happened. All the banks got cheap. It wasn't just the big banks that caused the problems that got cheap back then. All banks got cheap. They got down to 50, 60, 70% of tangible book value. Over the next 4 or 5 years, they traded up to 75, 80% of tangible book value. And these were the little banks that you guys all have in your towns and cities. Okay, 4 or 5 branch banks. You've known the guy that runs the bank and the mortgage loan officer. You went to high school with him. You played on the baseball team. Just little banks. They never had any fancy securities or, made a lot of stupid loans to foreign countries. None of that. From the time of the S&L crisis until 2000, the index of small bank stocks went up tenfold in just a little bit less than a decade. It's more extreme this time. And the M&A wave that's going to go through small banks over the next few years is going to be spectacular. The banks that don't get taken over are going to take substantial market share from larger banks and combine with other banks in mergers of equals that are going to see earnings and revenues grow, and they'll be survivors, and the stock's going to go up by many-fold of the price that you're paying now. I don't care if your emphasis is on trading between now and 4:30. If you're not putting some money into small bank stocks, you're leaving potentially millions of dollars on the table. So that's an area where we see a lot of value no matter what the stock market does. Right now, there's a very, very small group of stocks trading below net current asset value. If we see those, we buy those. There's about 5 of them right now. As I said, if I see them, I buy them. There's some selected semiconductors, like the one we used in the example. They have a lot of exposure to consumer electronics markets, which globally are very flat. However, you're going to see that pick up with demand for new additions of smartphones. Tablet computing is starting to take market share. These companies have exposure to that. So a few of them around trading at 80% of tangible book value. They all have an enormous amount of cash on the balance sheet. and the inventory is pretty much commodity stuff that can be liquidated at, say, 75 cents on the dollar if you had to. So they're very, very cheap. Going to have to wait for the global economy to kind of inch its way back into recovery, consumer demand to pick up. That should happen at some point over the next decade. I expect to sell them all at some point for many, many multiples of what I'm paying today. The other thing that I see is small brokers and asset managers, not the Goldman Sachs and Morgan Stanleys, but the smaller regional specialty shops that have decent research boutiques, good investment banking arms, specialized niche of the asset management market, are all trading relatively cheap. Nobody cares about them. They're just not on anybody's radar screen. They're sitting out there trading at 80% of tangible book value. Their balance sheets are really solid compared to their larger cousins in Manhattan and Chicago. Business is going to get better for these guys over time. They're going to take business away from the larger brokers, or somebody else is going to buy them at some point in time. So the stock's extremely cheap. Having said that, go right back up to that top line. It's a very thin opportunity set right now. In my deep value newsletter that I have on Marketfy, we're currently 74% in cash, I believe is the number. That's a brand new portfolio. It was just put together in June. Older portfolios that I managed for family and friends or for myself, where we still have stocks bought over the last 3 or 4 years, we're still a good, healthy 40% or higher in cash as we've worked through those stocks hitting fair value, being sold. There's just not a lot to replace them with right now. Okay, and this is the little slide that the editors over at Marketfy wanted me to run through. We have the Tim Melvin Deep Value Letter. We just started it back at the very end of June. I've looked at similar services to what I do. They run $2,000 to $10,000 a year, and most of these are aimed at the institutional marketplace. The theory seems to be that there's not a lot of retail interest in what we call long-term deep value investing. I'm hoping to change that, simply for the fact that it works extraordinarily well. And even if you make your living as a short-term, 2 or 3 hour at a time trader, you've still got retirement accounts, educational accounts, and other long-term funds that are probably better off managed in a deep value long-term approach than some of the other ways that you might want to consider managing your money over the long term. All right, now let me go back up. And so anyway, please, guys, we have a 30-day money-back guarantee on that thing. Please check out our letter. Give it a try. I think you'll be impressed with the results and the way we can improve your investment results. Okay. All right, let me go back up and take some of these questions. If you guys have any other questions, please think about them and get them to me now. We have about 14 minutes left. Okay, if options were available, would I buy the options instead? The answer to that question is, unfortunately, 90% of the time, the answer is no. Not much of an option buyer. I am something of an option seller. I love to sell puts to back into a stock. So if the market is dropping, and just pick a number, it's a $22 stock, and I absolutely desperately want to own that stock at 20 bucks, I will quite often sell the $20 put out a couple months or two if I can get a good enough price. If the stock falls below 20, I was going to buy it anyway. If it stays above 20, I collect the premium. So it's about as close to a win-win as you'll ever come in the stock market, is selling puts on value stocks. The key is you have to start with the valuation. Most option sellers that I know start with the option valuation and don't put a lot of consideration into the underlying value of the company. When that happens, you end up getting put a lot of stocks you really didn't want to own, and you have a problem. If one of my stocks gets put to me when I sell options, I'm a very happy camper. I was going to buy it anyway. I think I answered the one on stocks going bankrupt. When I was younger and not quite as wise as I am now, yeah, I had a few that actually went bankrupt while I held them. And that's a big part of what made me wise. Losing 100% of your investment, even if it's a small position, is a very, very painful experience. So what we've kind of figured out is we want to avoid debt as much as possible. If a company does go bankrupt and there is debt, I want to make sure there's enough equity left over top of that for me to get paid. And Carol asked a great question. If you're over 65 to 68, you don't have the time to do what I'm suggesting. And I will suggest that if you are a long-term investor, if you don't have 3 to 5 years, you probably shouldn't have the money in the market. Warren Buffett, and I'm not a huge Warren Buffett fan. I'm just going to throw that out there. He's a great investor, but I think he misleads the public to a very great degree sometimes. If you're buying stocks, you should buy it like you're buying a business and not care if the stock market was closed down for the next 5 years, because you're concerned more about the value of the business and not the piece of paper. So if you don't have 3 to 5 years, it's probably time to start backing some of that money out of the stock market. And I think with a value investing approach, you're certainly going to be safer than owning most of the run-of-the-mill mutual funds or index funds. I mean, how would you like to have been 68 years old and put all of your money into an index fund at the start of the year 2000? You would have just had a very rough decade. You were a value investor. You probably, based on my experience and the accounts that I managed over that period of time, you would have averaged 12 to 15% if you were extremely conservative in holding a lot of cash over that period of time. Why not buy leap options for the same return and a fraction of the risk? Because I can't tell you how long my stock, how long it's going to take my stock to work out. You know, leaps go out 3 or 4 years. What if the stock takes 5 years to work out? So generally speaking, no, we won't buy the leap options. It's not really a fraction of the risk because not too many leaps are going to be free of a significant amount of time premium. So I'm suffering day-to-day decay the entire time that I own that stock. I do not have voting rights in the corporation. I'm not entitled to dividends. All in all, I would rather own the stock just because I don't know how long it's going to take to work out over time. Can you make an income with value investing? Sure. If you take the universe and narrow it one more time by adding dividend requirements. But it's, and so, yeah, you could 4, 5, 6% from dividends from a portfolio of value stocks is totally realistic, especially if you develop the discipline to buy when markets, are down 10, 15, 20%. It takes extreme patience because you literally would not have been buying in the last year. The market has gone pretty much straight up. We haven't had a 10% correction. Very few dividend-paying stocks are trading below tangible book value, or indeed at anything like a reasonable value. The yield chasing over the last 2 or 3 years has been absolutely insane. We ran intrinsic value corporations calculations, on some of the larger blue chip stocks that have been so popular for dividends over the last few years. Companies like Procter & Gamble, McDonald's, Coca-Cola, these things are trading literally at 2 times what any rational person would pay for them because dividend-chasing investors have pushed them up so far. Large cap REITs, Simon Property Group, Avalon Bay, at the bottom, they were trading with great dividends. They really were. But money came in so fast, particularly from the ETFs, that these things are now trading at 3 times the property value. That's like buying a house for 3 times what you know it's worth to put money into those stocks right now. So yeah, you can put together an income portfolio using value stocks, but the patience factor has to be ramped up quite a bit. I think I just answered that. Yes, I try to put together dividend portfolios, but we haven't I haven't done much with it lately. There's only one or two stocks that I look at and I say, yeah, you can buy that and be okay. If your primary focus, by the way, is dividend stocks, if you really need the income that's coming from your dividend portfolio, I have to tell you that you have to be prepared. They're going to fluctuate anyway. If you've got an income stock portfolio, I really recommend buy safe and cheap companies, companies that you know are going to be there tomorrow, and don't look at the statement every day because it will make you absolutely insane if you're used to bank investments. Yeah, that is the only way to sell naked puts, is to sell them on stocks that you definitely want to own. And I'll let you in on a secret too. I post full margin when I sell puts. I do not use exchange margin. I don't use the broker's minimum margin. If I sell 10 puts on a $10 stock, I put $10,000 in the account. I do not want to have the exposure to leverage or expose myself to the temptation to lever it out and sell more puts than I want to own stock. I'm very conservative about that. Probably leave a lot of money on the table because you're selling puts on stocks that have a very low price to book value. Most of them have expired worthless on me. I've only really backed into a few deals because the stocks are already pretty cheap. Credit screening techniques. We use a couple. We start with, and we built off of, the Altman Z-score model that was developed by Professor Edwin Altman of NYU Stern University. His expertise really is more of distressed credits, distressed debt investing. But he developed a Z-score. It's widely available all over the internet. Combines 5 fundamental balance sheet and asset factors and comes up with a score. Over 3, it's safe. Between 2 and 3, it's kind of a gray area. Maybe they'll make it, maybe they won't. Below 2, the risk of bankruptcy is substantial. That's one of the first models that we run. We have variations of that model, obviously, that have developed over time. But you could use that one, I think, quite successfully with the vast majority of the stocks out there and introduce a margin of safety. Basically, you're predicting the likelihood of financial distress. You want to stay away from the ones that are at 2 or less and have a chance of bankruptcy. I don't have an aggregate performance, Bruce, and I probably should, but I would have to go down and do it all myself by hand since I started writing in 2008, and I'm intrinsically lazy. But it is being tracked on Marketfy at this point because we do verify every trade on there. So we should be able to keep you abreast of how we're doing going forward from here. And as far as my answer on not trading long-term options, they're not long-term enough. They expire someday. The stock does not expire. And you are always going to be paying time decay in these long-term leaps unless you buy them deep in the money, in which point you should have just bought the stock anyway. And you also miss out. You do not have ownership rights of voting, and you do not collect dividends. So not a real big fan of owning the long-term options on my stock picks. We do have a model portfolio. That's exactly how we're running this thing. Every week I'll go back through the model portfolio, and I'm going to post for subscribers. I've been doing this for a while now. Which stocks are buys at the current price, which ones have moved up to a hold. Obviously, if it's reached full value and is a sell, then we're going to put that up there right away, pretty much the day it hits that. Do I think REITs are cheap? No, absolutely not. Large cap REITs are incredibly expensive. If you look at them in our price to book or price to replacement value, the bigger ones are cheap. There are some small ones, some tiny ones, and some lesser known ones that are very, very cheap at the moment, but it's only 4 or 5 of them. The big REITs, way too expensive to own in here. As far as how many new purchases and trades do I make per year, that's really going to depend on what the market's done. Remember, I don't predict what the market's going to do, but I react to what it does pretty good. In 2009, we bought a lot of stock. I mean, I was scared to death. The world looked like it was going to end, but the discipline said buy. So we were buying. This year, not so much. There's not a lot of stocks to buy. Most of what has reached fair value did so earlier this year. Right now, in the model portfolio that we have up on the deep value letter, We're at 74% average tangible book value, and none of them are anywhere near their intrinsic value. Zach, as far as getting the info to calculate the Altman Z-score, you just have to go to the 10K and 10Q, pull up the balance sheets and the income statement, and you can pull it out. And no, I do not exclude stocks coming out of bankruptcy. Stocks coming out of bankruptcy have been huge outperformers over time, but again, only a very, very small subset of these stocks are actually going to pass our credit scores. Most of them, by the way, the vast majority of stocks coming out of bankruptcy are going back into bankruptcy. Ed Altman did a great study. He called them Chapter 22s. So you see the academic studies, and stocks coming out of bankruptcy have this huge outperformance over the first 2 to 3 years. It's less than 10% of the stocks that emerged from bankruptcy that actually provided that outperformance. I don't necessarily rule them out, but they absolutely have to pass the credit checks. So guys, my time here is coming down to a close. Again, I apologize for being the black sheep and being the one that did not talk about minute-by-minute trading, but I really think that even as a trader, you've got a lot to learn from long-term value investing. I might even suggest that if you're trading short-term, you can use a list of cheap stocks as your inventory list. So anyway, I'm down to about 1 minute and 20 seconds. Are there any? Yes, we do invest all over the world, not in this particular letter. This is mostly domestic stocks. We will eventually be coming out with a global letter. I own a couple of UK stocks here. Of course, I recommend The Intelligent Investor. I also recommend Chris Brown's The Little Book of Value Investing, since I played a big part in writing that book, and I think it's one of the best ones ever written, if I do say so myself. The Little Book of Value Investing by the late Chris Brown of Tweety Brown. Yeah. No, I do not hedge against market crashes at all. I react to what the market does. I do not try to predict it. Hey guys, I'm down to 28 seconds. Morgan, I really want to thank you for going so far against type and having a long-term value investor type like myself on here. But I've really enjoyed it, guys, and look forward to hearing from some of you again. Thank you very much.
All right, great. Thank you very much, Tim. Awesome job. Appreciate you being a part of today's event. And again, it's yeah, that's the thing I love about these types of events is you get to hear all kinds of strategies, whether it's the guy that's trading gold for 3 or 4 ticks, an options trader, a swing trader, or a value investor. So again, I think that you know, you guys definitely learned a lot from that. And here is a pretty cool deal. Tim's doing 20% off the guys at Marketfy, where every trade is verified. So you guys can click on that link right there that gives you 20% off of either $49 a month or $500 annual. I think the 20% off comes off the annual. But anyway, you know, what I would suggest, just try it out. See what you think. You get access to his commentary, weekly updates, trade ideas, and you know, if you find out within 30 days it's not for you, just tell the guys at Marketfy that you know it wasn't for you, and they'll credit the charge. So kind of a no risk deal there. They're good people to work with, and we've been excited about working with them over the past year. So thanks again to Tim and to all the great guys at Marketfy for helping out with today's event. All right, you guys enjoying today's event so far?